service. And we had looked at various types of costing techniques. We had looked at job costing. We say that we use job costing in the event that or organizations that use job costing are those organizations that offer a unique product or a unique service to each and every client that comes. And you find that the nature of these jobs are usually not that big. So they usually take a short period of time to finish. And yeah, they usually take a shorter time period to finish. So maybe a week, maybe a month. And each client comes in with specific requirements, unique requirements. And the organization now, what they need to do is to work with the specifications of the client. Then the other technique we used was, or we looked at, was the job costing technique. And under job costing, we say that this is whereby now, instead of producing a unique product for each client, the company usually provides the same identical product. So they produce the same identical product, many of them all together, then they just issue them to clients. And you said a good example is companies such as manufacturers of phones, manufacturers of, let's say, utensils, manufacturers of laptops, pens, those that are produced in masses. So the company produces the items in masses, all of them all together. And then what they do is that they now want to know for these products that we produce them in batches. And these batches, let's say we have a batch that is made up of 100 units or 10 units or 1,000 units, again, depending on the nature of the product. So what happens is that they usually accumulate the total cost for all these items. So what are the material costs incurred? What are the labor costs incurred? What are the overheads or other expenses that the company has incurred in order to produce those products? So they compute now for the entire batch. So if they wanted to know the cost of one item, then they're going to average the total cost of the batch over the number of units produced in the batch. And we're able to see that when we looked at this in the last class. So we had also now introduced ourselves to contract costing. We say that contract costing, this is almost similar to job costing, only that now this one usually involves larger types of jobs that they usually involve a lot of costs, and they usually take a longer period of time. So the contract, again, the company usually fulfills a contract to the specific requirements and unique requirements of each and every client. And we say that these ones are very common, especially in the construction industry. That within the construction industry, you find that the organization provides the specific request of the client. So if a client wants you to build them a bridge, you build them a bridge. If a client wants you to construct a 4-story building, you build them. If they want apartments, you build for them. If they want a mansion, you build for them. If they want something else, if they want a pool, you're going to construct that for them. So those ones now are going still to be to the specific request of the client, just as we did in the job costing. However, these ones usually involve a larger magnitude or a higher, a bigger magnitude. It is a job of a bigger magnitude, it is greater in size, and then also it usually takes a longer time period or a longer duration. So that is what we said was the difference between contract costing and job costing. That contract costing is a form of specific order costing in which costs are attributable to individual contracts, and they are usually undertaken to the customer's special requirements. They usually have a relatively longer duration, and they are also site-based. You see that you usually go to the site of the client, wherever their land is, for example, and that is where you're going to construct the building for them, the bridge for them, or whatever your contract is all about. And you say that mostly it is of a constructional nature. We had looked at some of the characteristics of a contract. We're not going to go back to that today. And we also looked at the distinction between contract costing and job costing. So today we will be looking at now the procedure of now coming up with the contract cost. What is the contract costing procedures? We say that costing in itself is the way the organization cumulatively aggregates the total cost that they have incurred in order to produce a certain product, to provide a certain service, or to, now in this case, to offer a certain contract. So we will be looking at how do organizations accumulate these costs. So like the job costing, like the batch costing, at the end of the day, when we are costing, we want to know in total, how much is the material cost? How much is the labor cost? How much is the other expenses, what we call the overheads? So the procedure for contract costing involves you coming up with the various costs of the business. And these various costs are usually included in what, or they are usually recorded in what we call the contract account. We will be looking at how do we prepare a contract account. So you'll find that each and every contract the business undertakes, it is going to be given a contract number so that you can be able to identify that these materials, this labor, these expenses that we have incurred, these are relating to contract number 1 or contract number 2, so that the company can know that in order for us to fulfill our responsibilities with regards to this particular contract, this is how much raw materials we used, this is how much labor we used, this is how much expenses we incurred, and the machinery that we used in this particular case, this is how much they depreciated by. So you always have to have a contract account, and a contract account is simple, just like any other T account, whereby you have the debit side and then you have the credit side. In this case, you will be recording all the details either on each side, the left hand side and the right hand side. We will be preparing this contract account in a few. So in the contract account, you are going to be recording details. You will record details about the various costs that the business has incurred, both what we call direct costs and those which are indirect costs. So direct costs, we say that these are costs that can be directly traced to a final unit of a product. In our case, these are costs that we can be able to allocate them directly to the contract that we have. That for this case, if we have raw materials, let's say you're a construction company, you utilize raw materials such as cement. So that cement, we can be able to say that the raw materials that we incurred here were cement, and we can be able to trace this cost directly to the building that we have constructed. So in such a case, the material itself is a direct cost. So you're going to include it as part of the cost that the company has incurred. So you're going to include all the direct material costs, or the direct labor, or the direct expenses that the business has incurred. We also look at what we call subcontract costs later on, and all these costs again, we can be able to trace them to the unit or to the contract, and therefore we are going to be adding them when computing the total cost of the contract. The other type of costs we will be including are also the indirect costs. Indirect costs, we say that those are costs that you might not be able to trace them to the final unit of the product, but you have incurred. When it comes to the costs, indirect costs, when you're dealing with contracts, these ones, because we can be able to trace them again to the contract itself, as much as we're not able to see it in the final product, but we can be able to trace them to the contract, then we are also going to be adding them up. So we're going to identify what are the indirect costs we've incurred. It could be that you have incurred electricity costs. It could be that you have had some machinery. It could be that you have paid people in order to perform some jobs during the contract, but these are not employees of the company, so they become indirect labor costs. So these ones, again, we are going to add them up. So any costs that are directly attributable or indirectly attributable, but you can be able to trace them to the contract, then in this case, you are going to record them, and you are going to record them in the debit side of the contract account. So we have the contract account. We're saying that this one is the debit side and this one is the credit side. This one is the debit side and this one is the credit side. So any costs that are incurred, they are usually recorded on the debit side. Any incomes that are coming into the business as a result of that contract, they will be recorded on the credit side of the contract account. So that is another element that we need to consider when it comes to contracts and contract costing, that we will consider all the direct costs as well as the indirect costs. You will be undertaking what we call, or we will be looking at what we call transfer of materials or plants. That if you have a factory, for example, in the business, and in the factory you transfer, not my factory, but if you have a warehouse or a store for your company, and you transfer materials from your store to the factory, it means that now you are utilizing these materials in the production process, meaning that you will also have to add any materials that have been transferred from the company's warehouse or company stores in order to now ensure that the contract is completed. That again is going to be included. So these are some of the factors that we will include. The other thing you have to consider is that when you are undertaking this contract, you're not undertaking the contract for free. So you are going to have what we call a contract price. A contract price is how much the company is going to get from the contract. How much income will you receive? So when you have the contract price, this one is an income, and according to the rules of double entry, incomes are usually recorded on the credit side. So we will be again recording the contract price on the credit side, so as to see how much income has this contract been able to bring into the company for that particular period. So those are some of the factors that we will be considering when we are preparing the contract account. Sometimes also we will be looking at for this particular contract, has it been able to bring in profit or has it made a loss? The contract is going to bring in profit in the event that the amount that has been raised in terms of the contract price and the income that has been received from the contract is more than the expenses and the costs that you have incurred. So if your costs are greater than if your costs are greater than the income that you've been able to bring in, of course, you're going to make a loss. And if now the business has been able to bring in more in terms of incomes than what has been incurred in terms of costs, then it means that the company would have made a profit. So we'll also be looking at, is this one a profit or a loss? And then once you have obtained the profit or loss, this one, the profit or loss is going to be obtained in the contract account, which is now going to be transferred to the statement of profit or loss. So every financial year, the company will be computing what we call a notional profit. So I'm being told that there is a problem with my audio. Everyone is experiencing the same problem?
I'm okay on my side.
Okay. Tabby? I don't know if it is my speaker. Tabby, have you responded? I don't know. Mercy? So you guys are okay? Unajua Mercy and Tabi naona mnaongea lakini sisikii kenye mnasema. Nyinyi mnanisikia? That is the most important one. You can type yes or no on the chat. Okay, Tabi says she's okay. Okay, so Mojo, I hope that is your name. Okay, Mercy says she can hear me as well. So Mojo, I think maybe it's a problem on your end. Try maybe increasing the volume or using earphones, because that one could also be the issue. Or maybe internet connection, because again, internet can sometimes make the voice break na shineki katika.
Sorry, hi, can you hear me?
Yes, I can hear you.
Oh, I have fixed it. There was a problem on my end.
Okay.
Okay, thank you.
Okay, welcome.
Oh.
So what were we saying? So we were saying that for every contract, the business will have to establish whether it has made a profit or loss, so as to be able to now know how much exactly have we made from each, and if we contract that the company has. So before we even look at the contract costing account in itself, then there are some special points that we need to note with regard to contract costing. So there's some computations that we will be making here and there, and we need to make notes of these points. So the first thing that usually goes into a contract account is the cost of the materials. So that is one of the major things that are also always going to include in the contract account. So it means that you need to know how much in total has the business used in terms of materials, and you'll find that sometimes these materials can be purchased directly from sometimes these materials can be purchased directly from the supplier. So, and you take them directly to your site. So it means that you need to consider how many of those have been transferred. And then there are some cases whereby you had some materials in the stores. So in this case, you did not necessarily purchase them, but you just took them from the stores and you took them to the customer's premises or to the customer site. So despite the fact that it was in your stores, remember before it came to your stores, you had bought them. So because you had bought them, then it means that you need to factor in what was the value of those items. So once you have done that, then you can be able to identify that for the materials. This is how much came in from stores. Maybe it was 100,000, or they were valued 100,000, and this is what we purchased from the suppliers, and maybe they were worth 50,000. So in this case, it means that in total you have spent 150,000 to purchase those goods or those materials. So you have to factor in the materials that have been specifically purchased in for the contract, and those ones that are issued from stores against the material requisition note. This material cost, you are going to show them as an expense in the contract account. And because it's an expense in the contract account, then you will be debiting the contract account with the amount of materials that have been purchased specifically for the contract, and also the materials that were removed and issued from the company's stores. The other thing that you need to consider is that sometimes you could really have taken some materials to the site and you ended up not using them, so you returned them. So it means that if you have returned them, then these materials were not used in the during the contract period. So it means that they are not going to make up part of the total contract cost. So when you return these materials to stores, also you have to go back and record these details in the contract account. So you record them by showing that, yes, we had made this one and we had shown them as an expense relating to this contract, but because we have now returned them, then it means that that cost has reduced. So therefore, you're going to record them in the contract account by crediting the contract account to show that, yes, we had initially taken it, but now we have returned it, and therefore we have not used it in the contract. So therefore we reduce the amount that the company has spent with regard to that particular contract. And then we have what you call materials at site. So you find that there are some cases whereby now you have a project, and this particular project, it is going to run for some period. Let's say it's going to run for an entire 2 years. So you have a project that is running for 2 years. In your last year, that is at the end of the first year, then you have some materials that are still remaining in stock and they are still in the customer's side. So, you know, for companies, you are expected to prepare your financial statements at the end of every year, regardless of whether you have completed the contract or not. So it will mean that if now you're closing your financial year and there are still some materials that are at site, it means that you need to record that there are some materials by the time we were closing the financial year end that had not yet been utilized. That yes, we had taken them from the company's warehouse and we had taken them to the site. But by the time we were closing the financial year, with regard to this particular contract, we had not utilized these materials. So these materials are lying unused at the site. And because we have not used them, it means that for this particular year, when you're looking at the total materials that the company has used, and therefore the total cost that the company has incurred with regard to the materials, it means that these materials that are still at the site will not be included. Let's say you had transferred materials worth 100,000 to the site. So they are currently at the site. Out of the 100,000, you used materials worth 80,000. It means that there's some material worth 20,000 that has not yet been utilized. You want to prepare the financials for the company. And one of the elements is the details on the contract account. You want to know so far for this particular contract, how much have we used in terms of materials? So you have used how much? 80,000. So as much as we had transferred 100,000, there's 80,000 what we've used, there's 20,000 what has not been used. So this 20,000, we are going to credit it so that we show that, yes, we had transferred 100,000, but there's materials worth 20,000 that have not yet been used, so that you can show that the amount that is remaining is 80,000, and that is what has been used to facilitate the operations of the company for that particular period on that particular contract. So that is why we say that at the end of each accounting period, value of materials lying unused at site is credited to the contract account and is carried forward for charging against the next period. That now those ones are going to be used in the next period, so they will be carried forward in through the next period. And we're going to see this practically when we look at an example. Then we have now the second thing that you need to consider, and that is the cost of labor. The cost of labor when it comes to the contract. You see, the labor you're going to have both direct labor and indirect labor. Direct labor are those employees that are directly involved in the production or in the construction process, and they will deliver the final item. And then we have the direct employees. These are the ones that are usually hired by the company, but are not employees of the organization for that particular contract. So you'll find that when it comes to the contract, we are going to include in the contract account all the wages of all the workers, whether they are direct employees or they are indirect employees. So all the wages that have been paid to employees with respect to that particular contract, they will be treated and they will be recorded as an expense in the contract account. So all wages of all workers engaged on a particular contract are charged direct to the contract, irrespective of the type of work they perform. So unlike other cases whereby we're saying that direct labor are only those employees that were involved in the production of the final product, and they are employees of the company, are the ones we include as direct labor and therefore include into the job. For the indirect labor, when it comes to the contract costing, we include all the wages for all the workers. We're not going to specify that, oh, because these ones are direct, then we include it into the contract, and then those who are indirect, we don't include it. We include of all the wages for all the workers that were engaged in the production or in the facilitation of the contract. The other special point we need to factor in is what we call the subcontract costs. There are some cases whereby you are the contractor, you have been given the job to perform and to develop, to construct, let's say, a building. But you find that your major aspect to it is the actual construction of the building. But there are some nitty-gritties here and there that you might need to perform. There are some jobs that you might need to perform, and you do not have employees within your entity that can be able to perform that. So you might have to now hire other parties outside the organization to undertake this job. For example, the glasswork, the steelwork, the painting. In this case, you might have to hire painters to come in and paint after you have done all the construction, because maybe you do not own, you don't have employees that are able to perform that role within the entity. So what are you going to do? It will mean that you will have to factor in that there is a cost that was incurred in this particular contract. These people were hired, the people who you hire to perform other activities which are not internally available within your entity, then we call them subcontractors. These subcontractors are going to be paid, and therefore the amount that you're going to pay to these subcontractors, either for the steelwork, the glasswork, the painting, these ones again you have to include it as an expense in the contract account. So the cost of such work is going to be charged to the contract account, and therefore it is going to be recorded again on the debit side. When you're listing the cost of the business, then you're going to list here the subcontracting cost, so that we know that in this case we have paid this cost in order to have the painting done, in order to have the glasswork done, or in order to have the steelwork done. So any work of specialized characters for facilities which are not available internally, they are offered to the subcontractor, and the amount that is paid to the subcontractor is going again to be treated as an expense in the contract account. So when you're preparing your contract account, you show that this one is an expense that the business has incurred. And we say that this case, the contract account on the debit side, we show the expense. On the credit side, we show the incomes and any returns that have been made during that period with respect to that particular contract. So that is again another important factor that we need to consider when we are preparing the contract accounts. Another important aspect, again, with regards to contract, is the payments that are made. So you'll find that we have contracts, and you say that for most contracts, they are large in nature, such that they are a big size, or they are large. Let me say large, big enough, sound different enough. Anyway, so let's say they are large. The contracts are of a big size, meaning that you cannot be able to fulfill them within a short period of time. So you find that most contracts are going to take more than 1 year before you're able to complete them. So they take more than 1 year. You will find that by the time the first year is ending, you have not yet completed the contract. There is a proportion of the work you're supposed to do that is not yet complete. The fact that you haven't completed doesn't mean that you are not paid, because you'll find that if it is a contract that is going to last for, let's say, 10 years, or let's say 5 years, or let's say 2 years, let's just even say 2 years. If it is a contract that is lasting 2 years, you as the contractor, you're incurring expenses. You're incurring expenses in terms of material, you're incurring expenses in terms of labor, and then now we have the other expenses, which we call the overheads. You are paying for these expenses. So it will be unfair for the client to do what? For the client to say that I'm only going to pay you when you have completed the work. It would be unfair to the company because they are going to be strained financially. So you find that now there's going to be an agreement between the client and the contractor that in this case, when you have been able to fulfill, let's say, a certain amount of work, maybe a certain proportion, a certain percentage of what is expected, we are going to pay you a certain amount. So let's say when you complete 30% of the project, we pay you. Or when you compute 50% of the project, we are going to pay you. But what is going to be paid is going to be based on the work that is satisfied by the client's engineers and or by the client's architects. That the client is going to have a professional come in and look at the project. That let's say we have a 5-story building that you are preparing. So let's say out of the 5 stories, you've been able to, let's say, do 2. And let's say the project, the entire project is supposed to cost you, let's say, 10 million shillings. So for the 10 million, you've been able to do 2 out of the 5 projects. So in this case, 2 out of the 5, you will expect that if I am to be paid a total of 10 million shillings, then how about maybe you pay me 2/5 of what you owe me? So in this case, you pay me 4 million shillings out of the job that I have done. But before this amount is paid, the architect has to come in and say that, yes, you have done 2/5. But out of the 2/5, what I feel comfortable about you having fully completed, then in this case, it is actually not 2/5, but maybe it is 1/5. So now we are going to pay you 1/5. And then now that 1/5 is what you're going to satisfy as fully being completed with regard to the to an extent that is satisfactory to the client and also satisfactory to their architect. So we are going to pay you 1/5 out of the total work completed. So you have completed 2 out of 5, but we are going to pay you 1 out of 5 because that is the work that the architect see has been satisfactorily completed. And therefore, we're going to pay you now how much? 1/5 of the 10 million. So we will pay you 2 million. The other one has been undertaken. You have completed it, but it has not been certified. So we call that uncertified work, or work completed that is uncertified. It will be paid for once the client's architect has certified in the future. So out of what you have done, out of these 2 stories, you are going to be paid what has been certified by the architect. Atasema mimi nimeridhika na the fact that you have built the first story is okay, but the second story, there are some things that I feel that have not yet been done to the satisfaction of the client. So therefore, that one is not going to pay you for now. We'll only pay you for the work that has been certified. So the payments will be based on the architect's certificate. So they're saying that in case of the contract, or in case the contract is small, full payment is usually made on the completion of the contract. However, in the case of large contracts, it may take more than 1 year to complete. In such a case, if no payment is received until the completion of the contract, financial resources of the contractor could surely become strained. Therefore, a system of progress payments is agreed upon by the parties. In this system, part payments of the contract amount are paid from time to time on the basis of certificate issued by the architects. And find that these architects usually work on behalf of the client, or whom we call the contractee. And the architect is going to certify the value of work that has been satisfactorily completed. Such payments received by the contractor are usually credited to the personal account of the contractee. It could be or should be noted that such payments are not entered into the contract account. We're going to show only what is the amount of work satisfied, or what we call work certified. Then also in the contractee's account, we're going to show that this is the amount that has been paid, or that this is the amount of work that has been certified with regard to the assessment of the architect. So now that brings us to work in progress based on what is work certified and what is work uncertified. So we have said that when the contract is not yet completed, but there is a proportion of work that has been completed and you need payment from the client, the architect is going to come in and look at the progress of what you have undertaken. And then they're going to see what amount of work is satisfactory and what amount of work that you have completed is not yet approved, and therefore it is not satisfactory, and therefore it is not approved. So work certified is that part of the work in progress which has been approved by the contractor's architect or engineer for payment. So this is what they're going to say, that this one has been done satisfactory. So therefore the company should go ahead and pay the contractor. So that one we call the work satisfied. And you'll find that the work satisfied is usually valued at the contract price. It usually includes an element of profit. And then we have now the work uncertified. The work uncertified is part of the work that has been completed, but it hasn't been approved yet by the architect or the engineer. So for this work uncertified, when you are valuing it, because it has not yet been approved, we don't value it based on the contract price, and therefore it doesn't include an element of profit. Instead, it is usually valued at the cost. It is valued at cost, and it is not or does not include an element of profit. And you're going to see this. So you have to have records as a business. For the records, you are going to show these records in the contract account. And the contract account is going to include both the work certified and the work uncertified. So this work certified is going to appear on the credit side of the contract account. So on the credit side of the contract account, the business is going to show that this is the work certified and this is the work uncertified. And then also, when the company will be preparing their statement of the statement of financial position, or what we call the balance sheet, they're also going to include that element as well. That in this case, this is the total amount that the company has earned, and this is the total work that has been certified, and this is the amount that has not been certified. And we shall be looking at that as well when it comes to the preparation of the contract account. Another thing that we need to know of, or another important concept that we need to know of before we look at the contract account itself, is what we call the retention money and the cash ratio. So we'll say that the company is going to have the contractor. So each company has a contractor, and for the client, for them to be satisfied, then they also have to have someone who is going to look at it and see whether the contract has been fulfilled with respect to the specification of the client. So the architect or the engineer. So the architect or the engineer goes in and looks at the work that has been done, and then they satisfy what is satisfactory, and then the other one remains uncertified. So let's say the work has been done and the architect or the contractor has certified that work worth 100,000 Kenya shillings, this one is certified. So it would mean that now the client will be expected to pay. They will be expected to pay the 100,000, but you'll find that there are some cases whereby the client might not pay the entire 100,000. Maybe they pay you 80,000 and then they remain with a balance of 20,000. So this 80,000 here, this 80,000 is what we call the cash ratio, that it is what the client pays out of the amount of work that has been certified. The other remaining amount is 20,000. This 20,000 is what we call the retention money. And the retention money is usually remains unpaid, or the client will now forfeit to pay it as a guarantee. The guarantee would be that, yes, I have paid you 100,000 for what you have done, but in the event that later on I find that there are some defects on this, then what will you do? You will have to come and repair those defects so that now I can pay you the balance. So it usually acts as a security that we have certified this, but because the work is ongoing, should we come and get a reason that now makes us dissatisfied with your work, then what are we going to do? We have this money, so we'll have to fulfill your obligations first before now we pay you. So it acts as a type of security for any defective work that might be found later on in the contract. So it just acts as a way that, yes, this is what is certified, we're going to pay you a proportion of it, and this proportion is usually agreed at a fixed percentage that either we will be paying you cash ratio of maybe 90% or 80% or 70%, and then we will have retention money of maybe 10%, 20% or 30%, again depending on the agreement between the contractor and the client. So that is why here you can see that it is usual practice not to pay the full amount of work certified. The contractee may pay a fixed percentage, let's say 80% or 90% of the work certified, depending on the terms of the contract. This one is known as the cash ratio. And then the balance amount that is not paid is known as the retention money. For example, if the cash ratio is 75%, the retention money will be 25%. This retention money is a type of security for any defective work that may be found in the contract later on. This also works as a deterrent for the contractor to leave the contract incomplete if he finds the contract unprofitable. So if someone is owing you, you'll always go back, fulfill that part of the contract, and then you are paid your amount. That for, yes, that part of the contract that you fulfilled, there's still an amount of money that you haven't been paid. So if someone is just paid the 100,000, the entire 100,000 for the work certified, and then they later on do their cash account, and then they realize, hey, this contract actually is not profitable. So you see, if you've been paid the entire amount, then it is very easy for you to just say, let me leave this contract. But if now there's some money that you haven't been paid, uta consider, wacha tu niendelee, so that now I can be paid my balance. So that is again another reason as to why sometimes we have this retention money. You might find that also in the future, if now there are any problems that are found, then the retention money can easily be adjusted against any penalties that may become due if the contract is not completed within the stipulated time as per the terms of the agreement. That yes, even if you would have finished the contract, mmemalizana nayo, there's still going to be retention money that is held, then you'll be paid after some time. So if now you fail to fulfill your contract within the specified time period, the company or the contractee can decide to forfeit the payment of this retention money, because now it will go to compensate them for you not completing within the scheduled time period. So thus, that is again another important element with regard to the preparation of contract accounts. Another important element is the profit that the company, you see that the reason as to why you have these contracts for most companies and businesses is so that now there can be a profit. I don't think there's a business that, unless you're a charity, and if you're a charity, you're not a business. So businesses usually have the intention of making a profit, and you'll find that for most cases, those companies that apply for tenders and contracts, the intention is to make a profit, not to provide services for charity. So you'll find that they'll have to now compute the profit. So even if the contract is not complete, then you'll also want to know, because on a yearly basis, when you provide services and you have earned an income, it is practice that you are expected to record the amount of income that you have received. So therefore, you have to compute for the total amount that we have done, as much as the contract is incomplete, how much profit is attributable to the amount of work that we have done. So we will be computing what we call profits on incomplete contracts. And there are two aspects of profit that we will be computing. We will be computing what we call the notional profit and the estimated profit. And then also we will see how this profit that we have computed, which proportion of it is going to be transferred to the profit or loss account. So we will start off with the computation of the notional profit. So what I need to remind us of is that you told me you guys have done financial accounting. Under financial accounting, we have some major concepts. We have this principle, which we call the accruals principle. The accruals concept, or the accruals principle, this is a concept that suggests that a company should record all its revenues when they are earned and not when the cash is received for them. And then also the expenses of the business, they should be again recorded in the company's accounts when the company has incurred those expenses. So you need to match the revenues for a given period with the expenses for a given period, so that you know how much is the profit for that period. So even if you have a contract that is going to go for 3 years, for this contract, you're going to have to divide them into the different years, the first year, the second year, and the third year. For this year, how much are the costs we've incurred? How much are the revenues we've earned with regard to the amount that we have completed as at this point? So therefore, what do? You have to now compute what we call the notional profit, or we have to compute the notional profit and estimate for this period that we have undertaken the contract, for the service we've provided, for the amount of work we've completed, how much in total have we made in terms of profits. So that is something that the business needs to factor in. So those are some of the things that the business will need to compute. So let's look at how to compute the notional profit. So the notional profit will be computed as the difference between the value of work in progress that has been certified and the cost of the amount and the cost that you have incurred in order to now make those items ready for certification. That how much did we incur in order to now undertake this job? How much have we incurred in terms of raw materials? How much have we incurred in terms of labor? How much have we incurred in terms of overheads for the amount of work that has been certified and approved by the architect? So in this case, now you show what is the value of the work we've done and what is also the value or the cost of the what is the cost of the amount of work that we have done. The difference between the two is what is going to give us what we call the notional profit. And in order to compute the notional profit, it is equal to the value of the work that has been certified. So you're going to compute the value of work certified, and then we will add the cost of work that has not yet been certified. Once you have obtained the total, you are going to deduct now the cost of work until that particular date. Then you'll be able to get what we call the notional profit. So we're saying that it will be equal to the value of work certified plus the cost of work that has not yet been certified. So in total, what is the total of the work that you have done minus now the cost of the work that has been done up to that particular date? That is the cost of the work that has been certified and also the cost of the work that hasn't been certified yet. That one should give us what we call the notional profit. So in any year, you are going to be computing the notional profit. And if you find that sometimes, because it is possible that for this particular year, the value of the work certified and uncertified is less than the cost. When what you're getting is less than the value or the income you're getting with regard to the amount of work you've done is less than the cost, then you will be making a loss. So if you find that in a particular year, the cost of work done exceeds the value of work certified and work uncertified, then instead of getting a notional profit, then you will be getting a notional loss. So it is possible. So let's look at an example here. These figures are just provided as explanatory figures. They are not computed from anywhere. So let's say we have a company that had value of work certified as 2 million, yes. The value of work certified was 2 million, and then the cost of work noted certified was equal to 150. So when you add the two, then you're going to get 2,150,000. And up to this particular date, the total cost of work done for both work certified and work uncertified, in this case, the total cost is equals to 1.9 million. It means that for the work that has been completed, then there is a notional profit of 250,000. So we will be utilizing this formula in the event that you are expected to compute the notional profit, and the notional profit you will be computing on a yearly basis if you have incomplete work. Then there is what we call the estimated profit. The estimated profit, this one now represents the entire profit that you would expect from a particular contract over the contract period. How much are you expecting to receive from this particular contract? So it will be equal to, what is the agreed price for this particular contract? How much have you agreed? So for this particular work, how much have you agreed? How much have you agreed with your client as the total contract price? And then also you're going to see how much is the total cost that the business has already incurred. This one, you're going to deduct it from the total contract price. And then you're going to consider how much more are you expected to incur in terms of total cost with regard to now the contract. Are there any extra cost that you are going to incur in future with regard to this particular contract before you fully complete it and deliver the project to your client? So let's say now we are assuming that we have a company, and this company has a contract, and the contract price agreed upon between the client and the business is equals to 3 million. And then now, so far, they have already incurred a cost of 2.1 million. It means that there is 900,000 that is left out of the agreed price. But this is not going to be retained in the business because there is an estimated additional cost that for us to be able to complete this project, we're going to incur an extra 350,000. So given that being the case, then it will mean that once the project has been completed, then it is estimated that if these are the only other costs we'll incur, then the company is likely to make a total estimated profit of 550,000. So you can also be estimating that even before you complete the entire contract, then how much estimated profit are we likely to make during that contract period? So now that we have been made aware of the various concepts with regard to contract costing, Then I want us to look at now how to prepare the contract account. So this contract account, we're saying that we have two sides. Let's take it as though we have two sides. We have the debit side and the credit side. So let's come here. We say this is the debit side and which one is the credit side. So the debit side, we are going to be showing the expenses, and the credit side, we are going to show the incomes and any amounts that have been returned to the business. So you usually start off with materials. So you start off with the materials that have been incurred. So you say that you're going to show the materials that have been purchased directly from the suppliers for this particular contract. Then also you're going to include any materials that have been issued from the site. So are there any issues that have been made from the site, and are there any issues that have been made from the company's stores? And then also, are there any materials that might have been supplied by the client themselves or by the contractee? So you start off with the materials. So you include all the materials that have been incurred. Then you go now to the labor costs. So in this case, you're going to show what are the various salaries and wages that you have paid to the, what are the various wages and salaries that you paid to the employees that were involved in the contract process. Then now the other expenses that you cannot classify either under labor or materials. So any expenses that haven't been factored in when computing the materials and the materials and the labor, then you are going to include them there. So you include all the other expenses that are directly attributable to this particular contract. We've talked about subcontractors. So any amounts that you have paid to the subcontractors, again, they're going to be treated as expenses. So you are going to include them in the contract account. So you come here and say, this is the subcontractor's fee that has been paid, and it is an expense to the company. If the organization did what? If the organization purchased non-current assets, plant and machinery, specifically for this particular contract, then it means that you have to include part of that cost. So include part of the cost of this plant and machinery. And how do we include it? We include it by now computing the depreciation associated with that particular contract. That in this case, let's say we have an asset that is going to be there for how many years? 5 years. And this asset, it has a value of 100,000. So we'll compute depreciation using the straight line basis, that in this case, the depreciation is going to be 20,000 per annum. So therefore, by utilizing this plant and machinery, we have incurred an expense of depreciation, and that depreciation expense is going to be included again here. So in this case, now we show the proportion of the plant and machinery that we are depreciating. Then what do we factor in as well? We factor in any other indirect expenditure that might have been incurred by the business, but can be associated with the contract. So are there any expenses, any other expenses that we might have incurred that now are relating to this particular product or this particular contract, not product? You are going to include it here as well. So that is what we include in the debit side. We go now to the credit side. So credit side is going to include any incomes, any returns that have been made by the company. So if there were any materials that were initially issued to the site and they have been returned, then in this case, you're going to show them here that now they were not used in the contract period. So you're going to include the material returns. If there are any materials that were sold that had been issued to the site, but maybe you did not use it, so you sold them. Any materials sold, you're going to include them, but you include them at the original cost price. How much had it costed the business to buy this material? So you're going to include them, and you've sold them. So it means that they are not part of what you spent to now have this contract ready for the client. The other thing is now the work certified that we just talked about. So in this case now, there is work certified for the work in progress. So the work certified, you're going to include it at the contract price, including the profit that has been made, because in this case, this one has been approved. For the work uncertified, you're going to include it at the cost. How much have you incurred in terms of material, labor, and other expenses to make this ready for the client? So the work uncertified, you include it at the cost to the business. The work uncertified, you include it based on the contract price, inclusive of a profit margin. Then now you have any materials at site. We just talked about this. We say that if there are any materials that are remaining at the site, it means that they were not utilized during the contract period. So therefore, what do? You show that these ones haven't been utilized. So therefore, you take them back. So you show that here we have again materials that are still at the site. Then now we have that plant and machinery. Remember, our plant and machinery, we say that we have purchased a plant that is worth 100,000. We have used it for 1 year. And because now it is expected to be used for 5 years, then we have depreciated it for a period of, we've depreciated it for that 1 year, and the depreciation expense is the 20,000. So it means that the written down value of this machinery is how much? 80,000. This 80,000, we're going to include it here, that this one hasn't yet been used. There's that depreciation bit for the plant and machinery, which we've included as 20,000, but this machine is still there, and you're going to use it again in the next year. So the written down value of this machinery, or what we call the book value, or the carrying amount of the machinery, is going to be included on the credit side. That is, yes, we bought it, but it is still here, and it still has this value, and it will be used in the future period. So therefore, the written down value of machinery again is to be recorded on the credit side. So now you have all your elements on the debit side. These ones, we say this is expenses. These ones are any returns that have been made by the entity, any profits that have been made, and the value, not profit, but the value that has been made through the work certified, and the cost of the work uncertified. And then now the written down value of the plant and machinery that were purchased specifically for this particular project or for this particular contract. So just like any other account, we have to balance off. So we usually have to balance off. So you'll find that you have to now compute what is the total value of the items on the debit side, what is the total value of the items on the credit side. So you'll find that in most cases, the total value on the credit side is going to be greater than the total value on the debit side. So if you find that the credit side is greater than the debit side, it means that we have a notional profit or a surplus. So therefore, to balance them off, we're going to show on the debit side here that there is a surplus amount, and that surplus is our notional profit. So let's say our credit side was 700,000, our debit side is 500,000. It means that there's a difference of 200,000. This difference of 200,000 here is the profit. So therefore here total is 700,000, you're supposed to balance off at 700,000. This total is 200,000. So this surplus, to now make it 700,000, it means that now we have a profit, a notional profit of 200,000. So that is how we compute the notional profit for a contract in a given period. So always remember this format that we have here. On the debit side are all the expenses that have been incurred during the contract period. And then on the credit side are any materials that were returned, any materials that were sold, any amount of work certified, any amount of work uncertified, the materials that are still at the site, and the written down value of the plant and machinery. So if now we found that the debit side now is the one which is higher, then it means that the costs would be more than the expenses. The cost will be more than what it has or the value of the contract. So it will mean that now we would have the debit side being greater than the credit side, and therefore the company would have made a loss. So if you find that the debit is greater than credit, it means that we have a notional loss. If you find that the credit is more than the debit, it means that we have a notional profit. So that is how we prepare the contract account. And I want us to look at an example. Now we put all these aspects that we have been looking at into perspective so that we can see how much the company is making as a profit. That is, what is the notional profit or what is the notional loss. So let's look at this example. So we are told that BBA Construction Company undertakes large contracts. The following particulars relate to contract number 125 that was carried out during the year ended the 31st of March 2015. So we've been given that the work certified by the architect is 143,000. The cost of work not certified, in this case we have been given, is 3,400. The plant installed at site was valued at 11,300. And the value of the plant as at the 31st of March, that is at the closing date, was equal to 8,300. So they have installed property worth 11,300, but at the closing date, it was worth 8,200. So it means that we have depreciation here. And the depreciation is the difference between the value of the plant at the beginning of the period and at the end of the period. That is, I believe, 3,100. 11,300 minus 8,200. That one should give us 3,100 as the depreciation. Then we have the materials that were sent to the site were equal to 64,400. Labor costs were incurred equal to 54,800. And then the establishment charge is equal to 3,250. So this is also another common cost that you're likely to find during contract costing. And it means that because it is an expense, again, it is going to appear on the debit side. We have been given additional details. We're told that the wages accrued, that the wages that haven't still been paid for are amounting to 1,800. There's also another direct expenditure of 2,400. There's still materials on hand that haven't been utilized. These ones are amounting to 400. And this there are some materials that they were returned actually at the end of the period to the store. They are amounting to 400. Then we have been given direct expenditure. And in this case, the direct expenditure, we have again two of them. I believe this one's there's a way it's may jumble up. Okay. So we have the direct expenditure accrued on the 31st of March 2015. And in this case, the direct expenditure is amounting to total of 200. When we say accrued, it means that it hadn't been paid for by the end of the closing date. So there's that expenditure that the company has incurred but hasn't paid for, so therefore it will still have to be factored in. Then the contract price, in this case, we have the contract price. This one has been misplaced. So the contract price is equals to 200,000. And the cash that has been received so far from the contractee is equals to 130,000. So the question is, prepare a contract account for the period ending the 31st of March 2015 and find out the profit. It was decided that the company is going to transfer 2/3 of the profit on a cash basis to the profit or loss account. So we are going to see how much again will be transferred to the profit or loss account out of the total amount that we get from the contract account. So let's start off by preparing our contract account for the period. And we say that in order to prepare the contract account is going to be prepared. It is going to be prepared by what? It is going to be prepared by showing the debit and the credit. On the debit side, we show the expenses relating to that particular contract. On the credit side, we show any materials that have been returned from the site, any materials that have been sold, any materials that are remaining at hand. We are also going to show the amount of work certified and the amount of work uncertified. And also if there are any plant, the remaining value of the plant, or what we call the written down value of the plant at the closing date. So let's now prepare using the details that we have been provided for. So we have here, the first one is the materials that were sent to the site. That in this case, you were told that the company sent materials worth 64,500 to the site. And this is what we have here. We have that materials sent to the site were equal to an amount of 64,500. The other thing you're supposed to show is the labor. So in this case, the labor of 54,800. And this is the labor that we were provided. The other expense we have is the establishment charge, and the establishment charge is equal to 32.50. What other expenses were incurred? So we have direct expenditure. So we were told that the wages accrued were equal to 1,800 on the 31st of March 2015. And also there was some direct expenditure. So in that case, we come here and show that we have a total of direct expenses of 2,400. Then there's that wages accrued by the time they were closing. And in this case, we are told that the wages accrued were equal to 1,800. So that is again another important element. Then there's the direct expenses that was accrued that wasn't paid for at the closing date. In this case, the 200 that we have been given here. So now we have again another element that is of the depreciation. So in this case, we were told that this item that we had, there's a plant at site, and the plant at site had a value of 11,300. So we come here and include that there is this plant at site that had a value of 11,300 at the beginning of the period. That is the cost of the plant to the business. So sometimes an organization can decide there are two approaches. You can either include the depreciation expense, or alternatively, you can include the entire amount. So in this case, we have included the entire amount of the value of the non-current assets. Either of them is acceptable. So once you have now included all the expenses that have been incurred by the business during that period, then you factor in any returns that were made during the period. So we had the materials that were returned to the site. In this case, materials returned to the site were equal to 400. Then we had also been given materials at hand. So we have materials on hand. We have here was equal to 1,400. Then materials returned to site was 400. So all of them, we include them. So materials in hand 1,400, materials returned were 400. Then there's the work certified that we were given. We were told that the work certified as at that particular date was 143,000, whereas the cost of work not certified was equal to 3,400. So we come here and include again those details. So when you include the total cost of the item of non-current asset on the debit side, then what you include on the credit side is the written down value. So in this case, the written down value, we're told that at the close of the financial year, the company had a written down value for this asset of 8,200. So we come here and include the value of 8,200. So next thing is we compute the values on the debit side and the values on the credit side and see which one is higher. So in this case, when we sum up, you're going to find that the values on the credit side are greater than the values on the debit side. So in this case, you see that the value on the credit side is equal to 156,400. Then now we come here and now check what is the difference between the two. So in this case, we'll have 64,500 plus 5,800, 54,800 plus 3,250 plus 2,400 plus 1,800 plus 200 plus 11,300 plus 18,150. You sum them, not plus 18,150, sorry, but plus 11,300. When you sum this up, you deduct them from the total value on the credit side. In this case, now we deduct them 156,400 minus this. It should give us a surplus of 18,150. So that 18,150 is what we call the notional profit. It is what we call the notional profit. So in this case, now we come here and say that the total notional profit is equal to 1,850. So in that case, this notional profit is going to be transferred to the statement of profit or loss. But now, before we transfer it to the statement of profit or loss, there is a note that we were provided. We were told that the company is going to do it. The company is going to, or it has been agreed that the company is going to transfer 2/3 of the profit on a cash basis to the statement of profit or loss. So you're going to use the cash basis. So in this case, the total basis, or what is the total amount that has been received. So in this case, you have received a total cash of 130,000 from the a total of 130,000 out of the work certified of 143,000. So therefore, we see what proportion of this has been received. So in this case, you've received 130 out of the work certified of 143,000. So out of this, we transfer 2/3 of the original profit. So this one is to compute the ratio of out of the notional profit that we have obtained, given the work certified and given the cash that has been paid for them, what proportion of it, what proportion of the total profit that we have made should we transfer to the profit or loss account? Because we're not transferring the entire amount because of the basis that we have been given, that we transfer on the cash basis. We have received 130,000 out of the work certified of 143,000, meaning that the other 13,000 is the retention money. So given that there's retention money, then we cannot acknowledge the entire profit. So now on the cash basis, we obtain the ratio 130,000 out of 143,000, and then 2/3 of this profit, which you have obtained of 18,150. The value we get is what we are going to transfer now to the statement of profit or loss of the company, or the income statement of the company as the profit for the period relating to contract number 125. So therefore, what do we do? So when you obtain the answer, we are going to get a total of 11,000. So we say that this one, 11,000, you're going to transfer it to the statement of profit or loss, and it is going to be debited with an income of 11,000. So we come here and show that the amount to be transferred will be equal to 11,000. So you see the total profit that was made with regard to this contract, this period, was an amount of 18,150, and we have transferred 11,000, meaning that there's 7,150 that is remaining. So this one is going to be transferred to the company's reserve. So we say that to the reserve, which now is the difference between the total notional profit plus what is transferred to the profit or loss account, that is what we are going to issue out to the reserve. So in this case, we say that the reserve is going to be now downward credited with an amount of 7,150. So that is how we prepare. That is how we usually prepare the contract accounts. So the main thing that you need to note of, because again, this is now a complex kind of contract account. For you, all you need to note is how do we record these items? When do we debit and when do we credit? When do we debit? You say that you debit with the cost that the business has incurred. So labor costs, expenses, those ones are going to be debited to the in the contract account. The ones that need to be credited are the materials that have been returned, the ones that are still at site, the work in progress, that is the work certified and the work uncertified, and also the value, the written down value of the plant at site. That is all we will be required to know with respect to the contract account. So I'd like to maybe open up the floor if anyone has a question on what we have looked at with regard to the contract account. You can do it. You can maybe unmute. You ask your question, maybe where you feel that it is not clear. You can unmute, you ask your question, we address it. Okay, so I believe that silence means no question with regard to this preparation of the contract account. So here we have some questions that I want you to look at later on, just to practice on the contract accounts and see if you can be able to as well replicate what we have looked into, and see if you can be able to know where to debit, what account to debit, and what account to credit with regards to the contract account. So I can say that it is almost 9. I know that I had I ate up into some of your time by starting late. Sincere apologies for that. I hope it doesn't happen again. I will make sure that I don't eat up into your time again in the future. So I'm going to also share these notes on the portal. I'll also edit the video and upload it again on your portal, so that if you want to refer to it in the future, you can be able to just go back and refer to it. Allow me to stop there for today. So these are the ones that are questions on what we have looked at. So we have the questions and then also the solutions. So just look at those questions and see if you can be able to answer them again based on what we have looked at. And then when we meet in the next class, if you see that you have a question based on what you would be going through in the questions, then we can look at that first thing in the next class before we proceed to the next topic. And with that, unless we have someone who has something to say, I'd like us to stop there for today. Anyone with a question, with a comment, you can unmute.
Just a concern.
Mm-hmm.
We have touched on the notion of profit.
Okay.
What about the estimated? Shall it also being part of this account, costing account?
Okay, so we said that yes, actually, yes, we have two types of profits. The estimated profit. The estimated profit is for the entire contract. So for the lifetime of this contract, from the beginning to the end, how much are you likely to make as profit? For the notional profit, it is for this particular year, that for this particular year that we have performed this contract, given the amount of work we have done, then how much profit have we made given the work that has been certified and the cost that we have incurred. So on a yearly basis, the company will be computing the notional profit. But the estimated profit is going to be computed only once, because now it will be computed that for this particular project, in this year, this is the total amount that we have made in terms of, this is the total work that has been certified, and this is the cost that we intend to incur in the future. This is the cost that we have incurred so far, and this is the contract price. So for our example here, because we have not been told on how much the company expects to incur for the other additional work that is to be done in the future in order to compute the job, then we have no way of computing the estimated profit. So that is why we haven't computed the estimated profit. But if you were told that the additional cost to complete this project was this amount, then in that case, we would be able to compute the estimated profit. So yes, you can be asked to compute the estimated profit if you have been provided with the cost that the business intends or expects to incur in order to complete the project. But if you've not been given, then the only thing you will need to compute is the estimated, not the estimated, but the notional profit for that particular financial year. Okay, so any other question that we might be having on this? Okay. So I'm going to send these notes. Kindly make sure you go through them. I can also say that we are almost running out of time. And see, it's like I think a month before you do your exams. So make sure you read through as we continue, because we might, if ukingoja sana, unaweza pata time imeisha. So as we do the topics, as you finish the topics, just make sure you go through them individually, so that by the time we are done with the syllabus, then you can just be able to identify which areas you have problems with. Then you can go through them, as we will also be going through the past paper questions. And with that, I'd like to wish you all a good night. Thank you for attending the class, and make sure kindly that you also do some of the practice questions that are there. And with that, have a good night and see you next Wednesday. Goodbye.